Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Hello, welcome back to the Risk Intel podcast. I am thrilled to have with me today one of our in-house subject matter experts here at SRA Watchtower and former financial institution risk and audit and operations and lending and credit and you name it professional in Kathy Jackson. Kathy, it's great to have you with us today. Thanks for joining us again.
Thanks, Ed. It's my pleasure.
Kathy, I had a conversation with Nikki White recently about the distinction between enterprise risk management and some of the other functions that I'm going to say are maybe tangential or complementary to the risk function. And one of the things we talked about was the distinction between audit and audit responsibilities and a risk manager. There was another area though that Nikki and I had begun to explore and thought maybe we'd like to bring in someone that has been close to these parts of the business as you have been, which is this distinction between GRC and vendor management and kind of supplier relations and things that kind of go under that GRC heading, and how that is discrete from audit and audit responsibilities. So I'd love to start there, if we will, and then maybe we can tie it all together to ERM at the end. But can you talk to us a little bit about what you see as the responsibilities of a third-party risk team or a GRC team or that function inside a financial institution?
No, absolutely. When I think about the governance, risk, and control side of the bank, management's ownership of those always comes to my mind, because at the end of the day, that's what we're asserting, that is what we are saying, that's what we're hanging our hat on, that when we do these things, when we have governance, and we understand our risk and we put controls in place, that is what management is responsible for doing. And when I think of audit, I just think that they're over here, and that independence is so important that they be over here, because it's their job to come in and prove you right. And I say prove you right versus prove you wrong. And so they're coming in to say, absolutely, these are the risks and these are the controls, and they're operating, and they appear to operate properly. They appear to be what's appropriate for the size of this institution. And we've gone in and we've done some testing and we've done some looking. And of course, as an advisory partner, we've done some advising on those. And so I see them as very, very distinct. From a governance and standpoint, and from every standpoint, they're very, very distinct functions.
So you've drawn that distinction there, and I think that certainly was clear to me that think of it as the audit being the check and the balance, right? The prove you right concept there, but they are arm's length, independent, unbiased, if you will, right? Not influenced, and they are whether you want to call it a sanity check or go farther to say, right, it's a true kind of governance check on the business. Let's go back to this this piece of the governance, risk, and controls, and how that really is. It sounds like from your description, really embedded, if you will, throughout the organization itself, and it's more a set of principles, if you will, or concepts than it is a discrete function per se.
Absolutely. It's that risk culture all the way down. It is saying the importance of these things are so important that we're going to memorialize them into a system of governance. These are the things that we do, right? And it's across. It's not just the financial piece of it, as you know. It's going to go across the spectrum of all the areas that can touch the bank. It's going to have that governance framework around it. And how are we making certain that we're first off identifying? We're going to identify those risks that are important for us to track. Some of those are going to be, I think, as Nikki talked about, they're going to be the SOX risk. And so those are those financial controls, right? Those are the ones that are super important because they're going to inform those financial statements that investors might be relying upon. But there's so many more, that are not the key or the SOX controls, that if they don't happen, then the whole thing can still go off the rails, even though they are not the ones that people think about all the time. And so go ahead.
Give us an example or two of those, if you, right? You said, right, I just want to pick up on it. So folks, let's be specific for people.
Yeah. It's those simple reconciliations that are supposed to happen, right?
Okay.
Those very simple, the day-to-day things that first line and sometimes even the second line people are responsible for doing. Because I can guarantee you every time a control breaks down, it's because this one thought that one was going to do their part and their secondary part, oh, if I skip it today, it's fine. Every single time. And so you have to have that in place where, yes, every time you do this, you must do this, this, and this. And it's the mundane and it's the not glamorous. But if it does not happen, whether it's a manual, because there are still some manual processes. Of course, we're trying to move away from those. But if it's a manual process, if it's a report you're supposed to review, this report is telling you something that's important, but you fail in that piece. And so all of those pieces, again, it's this giant puzzle that must come together. And every time a piece fails, that's an opening for a problem, every single piece along the way, right?
Right. So it's important then, right, to have awareness and clarity and tracking of those processes and the controls around them. Before we even get to, I think where I'm going to go next is, well, how do you become aware of it? How do you report on it? How do you look at it from that enterprise level? But fundamentally, you've got to track it all at a pretty micro level there and capture all of those controls and checks and balances are actually in place.
That is absolutely true. And you want to self-identify first. And by that, I mean the department where it's happening. So you want to have the controls in place in that department where we caught it first and we fixed it. And so, yes, from the smallest all the way out to where it balloons up to when it's in a formalized system, and then that independent function comes in to take a look at it. Before all of that, you want to make sure that internally, we've made all of our checks and balances, that we are going in and taking a look periodically at transactions the way those outsiders are going to do, and a way to track all that in a system, whether it's our RICSA system or something that a client has. The ability to track that in there is super important. And I'll say regardless of the size of the institution, even though you might not have SOX requirements, you need a framework to make sure everything is being, ticked and tied and done appropriately.
Right. And so, as you said, right, whether it is a robust SaaS solution or whether it's Excel, right, or whether it's a piece of paper, right, fundamentally, though, you need to capture it. You've got to track it. Because that's the only way you're going to unearth that there is a potential risk or a gap, or as you said, right, an entry point for something to go amiss.
Absolutely. Absolutely.
All right. So we've spoken quite a bit in the past, and Beth Nellis has been with us for a number of conversations around this topic, right, of capturing those, tracking that at a very micro specific level. Let's then tie that together then with this concept of ERM, right? You spend a lot of your time helping people create that holistic picture, right? That top of the house view of risk. How does something then like these governance and risks and controls and the visibility into what's going on there, how does that fit into that ERM picture?
Well, when we start talking to a client about ERM, we stress the importance of this is the top of the house. And so you're looking to capture the key controls and key risks that you've identified. Again, ERM, we're at the top of the house, and everything that happens underneath is going to be informative to the top of the house. And so that is where you bring, again, the key controls, your key metrics, what's important at the highest level of the organization that we need to keep that board of directors and our most senior management people aware of. And so we bring those up, and we bring them up. You know, if a client desires in as KRIs, everybody's familiar with KRIs, you bring those results in. You know, what's the risk of all your deposit regulations? What's the risk present in all of your loan regulations? Bring that up as a KRI and inform the level of risk present in compliance at the enterprise level. So you pull that information up and help inform.
Okay, let me try, and I'm going to ask you to poke holes in this, or correct or clarify, or just start again. But if we think of it, that there are governance, risk, and controls that need to be in place on a day-to-day basis. There's then an audit function, if you will, that then will come in and be the check and balance on that, and then the findings, if you will, subsequent to that audit process, that would identify these are some of the key risks or metrics or controls that then flows up into an enterprise risk management view. Am I thinking about how those three things, if you will, kind of connect together?
They absolutely do, and you said it perfectly. And in fact, the results of those audits can flow up into ERM. You know, how many outstanding audit issues do you have? That's a great KRI. An even better KRI is, you know, how many substantial audit issues are past due. That's a great ERM level metric that's going to come directly out of, you know, the audit. You know, then in looking on the control side, you know, what do our audit findings tell us? Because audit findings, the absence of findings or tons of findings, tell us something at the enterprise level about our controls. And so there's always going to be an enterprise level control assessment of how are we doing audits and examinations. So all of it flows up, and all of it informs, gives it that high level picture, what is happening in this organization. So I love the way you put all that together.
I think thank you, Kathy. And I think that you built that foundation for us there, right? That these three pieces, they're all pieces in the puzzle, right? And maybe the enterprise level is how it all comes together and you see that puzzle. But you need to have the risks and the controls captured at the micro level. You need to have the ability to then audit that. And so there may be a place for, a GRC system or framework, right? If you start with that, then an ability to audit that, and then the ability to take the outcomes of the audit and the outcomes of the GRC as two of the inputs, along with a number of other things, right? Operational, right? Strategic, right? Credit, liquidity, all that other stuff to get that ERM picture. And so having a framework or a system that allows you to capture GRC intelligence, audit intelligence, as inputs into that ERM view, right? And whether that is scratch pad and a piece of paper, an Excel file, something sitting on SharePoint, or a SaaS system, right? The important thing is it occurs at the detailed level. There's a check and balance on it, and then it's aggregated up ultimately to the top of the house.
Absolutely. And the aggregating up is key. The more that's getting aggregated up, the better that picture for that audience of ERM.
Yeah.
You can bring in your audit findings and, attach them to an attribute that's just continuously informing what is happening, even down to that attribute level. And it keeps it within view of the people that are making those decisions, those strategic decisions, and others, when you can tie it all together. And again, not plug in Watchtower, but our system does that for you to give you that view, the highest level view, and then you can work your way all the way down to the lowest level view. And it all works together to tell your story of risk at your institution.
So it sounds like that's the little bit of homework we're going to leave our listeners and watchers with here today, which is to, press on this topic when you're talking to your solution providers, and make sure that these systems communicate with each other. The data can flow from one to the other, so that ultimately you get that holistic view of risk, the top of the house view, as you say, Kathy, that also allows you to drill down and see the underlying data that gives you that big picture.
Yes.
Great. Kathy, thank you very much for the time. Appreciate you helping us put these puzzle pieces together of GRC, audit, and ERM. Hopefully this has been helpful for our audience this week. Thanks so much.
Thank you. Always great to talk to you, Ed.